certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. Yeah. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
Well, I look at a lot of figures just in connection with our businesses. I like to get numbers. so I'm getting reports in weekly in some businesses. But that doesn't tell me what the economy is going to do 6 months from now or 3 months from now. It tells me what's going on now with our businesses. And it really doesn't make any difference in what I do today in terms of buying stocks or buying businesses, what those numbers tell me. They're interesting, but they're not guides to me. If we buy a business, we're going to hold it forever. So we're going to have good years, bad years, in between years, maybe a disastrous year some year.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks.
Well, I think anybody that's investing in the stock market has to understand, you buy a company. These are not lottery tickets. These behind every stock there's a company. If the company does well, over time the stocks do well, and vice versa. You have to look at the company. That's what you're researching. That's what we do at Valley. That's what I do.
Think about principles of investing that may help you. First, invest you must. The biggest risk is the long-term risk of not putting your money to work at a generous return, not the short-term, but nonetheless real risk of price volatility. Even though stocks seem very high, consider what I said in my book, a little plug there. Never think you know more than the market does.
As a wise man once said, if there's nuclear war, it won't matter a hell of a lot whether you own stocks or bonds. It's gone. Society is gone. It's frightening to think about. Mm-hmm. And I think that given the enormity of these kind of risks that I've described and the unknown risks that we really don't know, we don't know what they are, which is kind of frightening. But invest you must. As I've said to people, probably on television or interviews kind of thing, the one way to assure that the value of your retirement plan is zero is to not invest a penny, and zero is guaranteed. So you have to put your money to work.
One of the biggest mistakes many of us retail investors tend to make on different stages of our investing journey is forgetting the lessons that the greatest investors of our time have tried to teach us time and time again. We live in an era where information is more accessible than ever, and that has been a phenomenal thing to most of us, considering how much we all have benefited from this great gift of the modern world. For the common individual, starting an investment portfolio and securing a safer financial future for ourselves and for our families has never been so readily accessible. But of course, there's a downside to it. This almost immediate access to everything that is happening worldwide, either in the stock market or in the economy as a whole, can also affect us negatively. Knowing so closely what's going on in the world and being so permeable to a large range of opinions and reactions to the facts in the news and on social media, all that, more than ever, poses a threat to our emotions. And when you let yourself be guided by emotions instead of reason, that's when you deviate from the basic principles of investing and make your worst mistakes. Every time you listen to the likes of Warren Buffett, Peter Lynch, Jack Bogle, and many others, there's one thing that's almost always certain. They are always loyal to their principles. It doesn't matter if you watch an interview from 25 years ago or from last year. All these great investors have been saying the exact same things since, I think, forever really. Their opinions on certain aspects of the economy, business sectors, individual companies, or even asset classes may have changed over time, but their principles have always been the same. Views and opinions can be changed by new facts and events, but the principles of investing are unchangeable, no matter what. The real lesson from these great investors that we must keep forcing ourselves to remember is this one rule to build wealth. It's the principle of principles, that essential concept every single one of them has always followed, and that is consistency. In this 1997 speech, Jack Bogle presented the audience with 5 principles to invest money in, quote, interesting times. And here we are in 2021, so it can hardly get more interesting than this. So let's quickly sum up his 5 rules. 1. Invest you must. There's no bigger long-term risk than not putting your money to work, and that applies even when stock prices are at historic highs. 2. Give yourself all the time you can. Investing will only make you wealthier provided that it is a long-term commitment. You must allow the combination of time and compound interest to perform its miracle. 3. Be mentally prepared for market declines. Your expectations on stock market returns must be realistic. The market won't always follow an upward trend. Short-term market declines are inevitable. They will keep coming no matter what. But every negative period eventually shall pass. Never let your emotions affect your long-term strategy. 4. Rely on simplicity. Investing may not be easy, but it sure is simple. You should aim to build a balanced, well-diversified portfolio, having low-cost funds as its backbone, and always be wise and realistic when it comes to weighting your level of risk against your expected returns. 5. Stay the course. Resisting the urge to withdraw the money from the market at times of turmoil is perhaps the most common mistake investors make. The tendency to buy stocks when the market is booming and selling them the moment the market goes down is what keeps leading so many investors to financial ruin. These 5 principles are sound, and I think every retail investor should follow them no matter what. However, while they may be necessary conditions to achieve financial success, they are not sufficient conditions. The key element behind all these rules is consistency. If you follow these principles for the next 5 years, but completely ignore them from 2026 onwards, you are guaranteed to lose money. And yet, many investors keep doing exactly that. Now, of course, you are never guaranteed to make money regardless of how you go about. As Bogle wisely said over and over again, over the long run, there are events out of our control that may compromise even the wisest strategy. But invest you must. If you follow these basic principles and if your approach is consistent, your chances of success are the highest they can possibly be. If you don't invest, you are guaranteed to gain nothing. And I think that's a shame because we should always strive for a better financial future. Thank you for watching and see you next time.